Thanks, Tina. This week in On-Chain Reaction, we're going to delve into the miners ecosystem. Miners are an integral part of the Bitcoin network. They're the ones responsible for taking transactions that you and I send and mining them into a blockchain. So having a healthy mining economy is very important to the long-standing nature of the Bitcoin network. So we're going to look at 3 different metrics today from the ByteTree Terminal in order to evaluate how healthy the mining ecosystem is looking. So the first metric is called Miners Rolling Inventory, or MRI. The Miners Rolling Inventory looks at the inventory position of miners over different time periods. So we could look at it through a day, a week, a month, or even longer. So to find the miners rolling inventory, we look at the number of Bitcoin that are mined for the first time or generated, and those that are sent out of the mined wallet. We call that first spend. So if miners are sending the same amount that they are generating, then their inventory is essentially flat, so it's 1. If miners are building up their inventory, so you have a lower first spend and a higher generation number, then what we see is that MRI drops below 100%. And vice versa, if there's more spending taking place than there are coins being generated over a given period, well, that means that miners are pulling from inventory they've generated in a previous period in order to sell or to move them now. So the MRI is an interesting metric for gauging miner sentiment in the network. There are a lot of different reasons that miners may move their coins, and we can't say exactly what the reasons are because the data is still quite difficult to interpret. Some ideas about the reason that coins are spent for the first time are that they're programmatically being sent to mining pools, but then you would expect to see a certain rhythm of transactions taking place. Another would be that miners are selling their inventory in order to cover their costs, and again, you would expect quite a regular behavior of new coins being sold. So then that leaves us with the third option, which at ByteTree we believe is the strongest argument at the moment for this metric, which is to say that actually miners are quite revenue-driven actors. So they don't want to sell their Bitcoin unless they think they can get a good price for it. You know, there's a lot of new Bitcoin that are mined each day, 6.25 every 10 minutes. And that's new supply that's coming into the market for the first time. So if there isn't a strong bid in the market in order to buy up those Bitcoin, then the price is going to drop. It's still a relatively illiquid market. So we use MRI at ByteTree to understand when miners view the market as strong and therefore they're selling, and when they're holding back, we generally see it as weaker. So looking at this chart, we can see MRI since the beginning of this year. What's really interesting about MRI is up until the halving period, we were typically seeing that miners were offloading their inventory. So you can see MRI sitting above 100%. As we came up to the halving, which is shown by that dotted vertical line there, you can see that MRI actually started to drop. This meant that miners were holding back their Bitcoin that they were mining, and we think in search of a higher price coming through the speculative premium associated with the halving when everybody gets a bit overexcited. What we can see as soon as halving happened on the 11th or 12th of May, the MRI started to go up again, which means that those coins that had been building up in inventory were offloaded. Another interesting pattern that we're seeing in MRI since the halving is actually the volatility in the metric itself. You can see we had a sharp increase up to about 106% in the month or so after the halving, and then a sharp decline again, down to a low of 94%, which says that essentially miners are holding coins that they're generating on inventory at one of the highest rates we've actually seen in the last years. At the moment, MRI sits at about 99%, but continues to be volatile. So the second minor metric that we like to look at is fees as a percentage of revenues. Fees are an interesting concept, and we touched on this last week. Fees give us an indication of network demand from the buyer's side, so us sending transactions, because the more we're willing to pay in fees, the more congested, or perhaps to put another way, the longer it will take to get a transaction approved on the blockchain. So we're willing to pay fees in order to prioritize our payments. What's interesting from a miner's point of view is that fees make up an increasing percentage of the revenues since the block reward halved. So miner revenues went from about $120,000 per block pre-halving to now $60,000 per block. That's about $18 million in a day across the whole network, down to $9 million a day. So as Satoshi envisioned, as the block reward halves every 4 years, there needs to be some offset for miners in the shape of fees. So fees as a percentage of the total revenues increase, and we can see that really that's been happening. So the very high peak that we can see was in fees as a percentage of revenue was initially around the halving. And that happened because difficulty dropped, which we'll move to in a minute. And therefore, a lot of miners went offline. So difficulty dropped, the hash rate then dropped, responding to that, and transactions couldn't get through. So there was a sort of plug in the network that drove fees up. But ignoring that spike and looking to the right-hand side of this chart, you can see that actually fees are trending up steadily as a percentage of revenue. Excuse me. So the last metric we're going to look at is the network difficulty. So difficulty tells us what is the total amount of computer power that's being allocated to the Bitcoin network. So you can think of this as the total capital expenditure that's gone in, as well as the operational expenditure. So you've got the capex, which is your machines and your infrastructure, and then you've got your electricity on the operational side. So we can see that in March, difficulty actually hit an all-time high. Before then, the sharp decline in price led to miners going offline. Profitability was squeezed, margins were squeezed, and subsequently difficulty dropped sharply. Now that's quite to be expected around halving, even aside from the fact that the price dropped, because what we mentioned, the revenues drop. So what's happened now? Well, the miners have been relentless in their pursuit of Bitcoin despite the reduced block reward that they're getting. And we can see that difficulty is now at an all-time high, which means that we have the most hash power ever allocated to the Bitcoin network. A truly exciting moment where we say that this network is continuing to grow and continuing to live on in Satoshi's vision. So that's all from On-Chain Reaction from me. We'll see you again next week.